Hello, everybody. So today I want to talk about strategy versus JP Morgan, and I want to talk about Bitcoin-backed credit. We know Saylor has been smiling all of the latest interview he's done. The stock is under 200. He's smiling. He probably knows that he has the next unlock for the future of Bitcoin. And this, it's not an endorsement per se. You still have a lot of people at JPMorgan who do not like Bitcoin, but clearly there's teams at JPMorgan that love Bitcoin. Issuing a price target of something like 250,000 for, I think, 2 years from now, something like that. I really try very hard to not pay attention to anything JPMorgan does, obviously, but this took my attention. This is a big deal. Jeff Park, but plenty of people reporting on this morning. JPMorgan files a Bitcoin note offering up to 1.5 Bitcoin gains, 1.5 gains via BlackRock ETF, a note structure on the IBIT ETF. So, in other words, and by the way, this is I guess it's the usual shenanigans of financial advisors. This is a structured product. It's designed to earn fat fees. That's what these products are designed for. Wells Fargo advisors will be earning a 2.82% flat fee. When I think you have people who complain about the fees of Cathie Wood, who charges like next to nothing compared to that. Anyways, this is just crazy. But not only do you get a fat fee in that instrument, but you also get, most likely, no financial advice, but most likely the return is going to be 16% because JPMorgan is expecting IBIT to be up next year in 2026, and so you would have that capped upside at 16%. Now, if IBIT is down next year but goes back up again in 27 up until 28, you may get 50% return over the next 1 to 3 years. 50% return in 3 years. Remember what Saylor teaches us. The Bitcoin 2024 model is telling us 29% ARR for each year going forward until 2045. So they essentially want most of the upside, and they give you back a 16% yield, and they take a fat fee of 2.8%. And so I would argue, of course, and this is kind of why Saylor shines and Saylor is smiling, because Saylor absolutely engineered a much better instrument, which of course, a lot of old money just goes through their financial advisor and sees this and they're like, oh, that's juicy. But people who are in the know, and knowledge is becoming more and more flat thanks to YouTube, thanks to podcasts, thanks to X. People who are in the know are, in my view, much more likely to buy the instruments that Saylor created. Saylor created a quote-unquote, this is what I've called a modern stablecoin. He created a modern stablecoin type design trading on TradFi rails. To me, these instruments that he created are really modern engineered instruments, but they are not on blockchain rails. They are on TradFi rails. It's a Trojan horse. He created a Trojan horse. There's no other way to put it. By the way, they're all down nicely this morning. I guess Bitcoin credit is taking hold this morning. It's buzzing. Bitcoin not doing much, but the preferred of Saylor are actually rising. Now you can see these preferred. Saylor, if you do the stretch over the long run, will trade at 100. It is designed to trade at 100. We've had liquidity issues in the market, but it's designed to trade at 100. Effective yield is 10.8% right now, because 10.5% is the yield, but we're not trading at 100, so you only pay 97. Your effective yield is 10.8%. Of course, STRD, which is the junior instrument, which is lower in the capital structure, yields 13.61%. And Strike, which is my preferred instrument because it comes with a call option on a strategy, a call option for $1,000 strategy with a strike of $1,000. That's why it's called strike, where 10 shares will convert to 1 share. 10 shares of strike will convert to 1 share of strategy whenever strategy reaches $1,000 or more, which in my view it more than inevitably will. So when that happens, right, you can convert them, and that still yields 10% right now. So that still yields 10%. So and strike has seen something like 35 to 40% of the volatility that you see in MSTR shares. You get in strike. So it's way less volatile. You still get a lot of upside from Bitcoin. It's not capped. The upside that you get from Bitcoin in strike, in the strike instrument, is not capped like JPMorgan's cap. And this is the innovation that I guess, I guess if you go through TradFi and a TradFi product, yeah, you have to keep going back to the financial advisor and you have to keep paying back the fees whenever the note comes due. Think about the lack of innovation of JPMorgan. It's a note for September 2028. It's a note that ends in late 2028. There's no innovation. Saylor went back with AI and went back to instruments that used to be a thing in the 1600s, and he created perpetual. All of his instruments are perpetual. You don't need to go back to your financial advisor every year for you to roll over into a new instrument with fat fees. To get that capped exposure, or to get that modified vol exposure, you don't need to go back every 3 years to pay those fees again. We don't spend enough time talking about the strength of the perpetual nature of these instruments. And one of the things we don't talk enough time talking about is because this is structured as a bond, so you're going to be taxed like crazy, especially if you live in a state like California or New York. You're going to be taxed through the nose for this because this is structured as a bond. Saylor, genius that he is, structured these instruments as tax deferred. Why? Because he figured out that he can pay a return of capital. As long as he makes sure that he doesn't make money, he can pay a return of capital dividend, a ROC dividend, which means that you effectively start paying taxes on strike, stride, stretch, stripe. You start paying taxes on these after you've recouped your entire investment. Once your cost basis is zero is when you start paying taxes on this. So for an instrument that yields 10%, let's say you want to go with the safer instrument, either stretch or strike, you take an instrument that yields 10%, that means it's effectively going to take you 10 years to recoup the initial investment for return of capital, and so you'll be starting paying taxes on year 11. So that means that for the first 10 years of compounding, which face it, the next 10 years are perhaps the most important ones for Bitcoin, that's really when you want to delay taxes, you're going to get effective yields that are much, much, much higher. This is what it talks about. Assuming you are a high income individual, you are in the highest tax bracket, 37% federal income tax. The tax adjusted, the equivalent yield that you would need to earn if you had to pay your full taxes would be actually much higher yields mostly north of 15%, actually up to 21% for the junior. That's how much you would actually have to earn in order to get that same effective yield. So the delay in tax is actually an extremely powerful instrument, extremely powerful. That's the same concept as ETFs, but applied to a perpetual credit instrument. And lastly, you get high BTC ratings. Now, of course, JPMorgan is one of the too big to fail institutions. So yeah, JPMorgan is going to pay you back because we're too big to fail, right? You have a government backstop. Strategy doesn't have a government backstop, but it has a rating on its credit, a debt rating that is higher than Apple, that is higher than the most biggest financial institution like Apple. They have higher rating. And these ratings, keep in mind, once the converts are paid off, the ratings on all of the preferreds are going up. And so what do I mean by BTC rating? You take Strife. Strife is their most senior instrument in the capital structure. You have a BTC rating of 6. What does that mean? That means that they have 6 times as much money backing Strife. So it means you have $6,000 in the bank. of permanent capital and you're borrowing $1,000. You're borrowing $1,000. You have think a bit more like that. Is if you look at Stretch, for example, you have $4.6 million worth of Bitcoin, and you go see your creditor and you're like, I'm gonna borrow $1 million. That's what a 4.6x means. That's why if you go to TradFi, most companies who issue bonds have, BTC ratings. Well, I guess for the best one, it would be like a 2. But that's for the very, very, very best one. Most companies that borrow money have BTC ratings that are like 0 or 0.1 or 0.2 or 0. Why? Because most bonds, most credit is backed by business endeavors with risk. It's backed by, I'm going to invest in a new store and my store is going to be successful, and the cash flow from that new store I'm going to use to repay you that debt in the future. It's not backed by permanent capital. Only the strongest financial institutions have their debts backed by financial capital. This is not what you get with strategy. With strategy, the money that you lend, to strategy in those preferred stock, that money that you're lending to them is backed by 6 times as much money stored in Bitcoin in perpetuity. So that's the beauty of the instrument that he created. And of course, Saylor is doing education. There's education. It's gonna take a long time to educate people on this, but the education has started. And to me, it is inevitable that people catch up to this. And so, of course, on a day like today, the day before Thanksgiving, I wouldn't read any stock market movement today. Like today people are on the road in the US. Today people are flying in the US. So they have price action. I mean, it's roughly flat, whatever. I mean, IBIT is up 0.6. MSTR is up 0.4. Yeah, technically MNAV is just a tad lower than yesterday, but MNAV has pretty much bottomed. I mean, we're pretty much at the lowest we've ever seen it. I wouldn't read too much in the price action of today because of the nature of the trading day today being a short day. The market closes in 40 minutes. But I would definitely look at this as a highly positive that the largest financial institution is launching a Bitcoin note, a Bitcoin structured note, a leverage play. This is crazy. This kind of feels like an endorsement of what Saylor saw before everybody else. And so that's pretty genius in my view. And yeah, the market will wake up and see why actually the strategy instruments are much better. But that's just my view. So anyways, what do I know, right? This is not investment advice. This is obviously not financial advice ever on this channel. This is only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.